Stop watching the flashing lights. Stop watching the ticker tape scroll across the bottom of your screen like a cryptic message from an indifferent god. That stream of green and red, of upticks and downticks, is not your path to wealth. It is a siren song luring you onto the rocks of financial ruin. It is designed to make you anxious, to make you feel like you need to act, to trade, to do something. But the greatest secret, the one that separates the permanently wealthy from the temporarily lucky, is that the most profitable action is very often no action at all. The entire game of watching stock prices is a distraction. It's a sleight of hand designed to make you think you're playing a game of speed and reflexes, when you should be playing a game of patience and business acumen. The real work isn't done watching the screen. It's done long before, in quiet rooms, reading annual reports and truly thinking about what makes a business great. The central promise we are exploring today is a principle so simple it seems almost insulting, yet so profound it has created more wealth than any complex algorithm or trading strategy ever devised. The principle laid down by the master of the craft, Warren Buffett, is this: investing is most intelligent when it is most businesslike. This single sentence is a revolution. It's a complete reframing of the entire endeavor. It asks you to stop being a speculator, a gambler placing bets on symbols, and to start being a proprietor, a partner, an owner. It prevents the most costly market mistake imaginable, treating the stock market like a casino. By the end of our journey today, you will have undergone a fundamental transformation. You will no longer see a stock as a volatile blip on a chart. You will see it for what it truly is, a fractional ownership stake in a living, breathing business. This shift in perspective will force a more rigorous, a more disciplined, and ultimately a vastly more profitable decision-making process into your life. You are about to learn how to invest not like a trader, but like a CEO, and in doing so, you will lay the foundation for guaranteed long-term growth and true, unshakable financial freedom. Our first pillar, the very bedrock upon which this entire philosophy is built, is what we will call the ownership mindset. This isn't a tactic, it is a fundamental shift in identity. It is the conscious decision to stop thinking like a renter of stocks and start thinking like a permanent owner of businesses. To understand the power of this shift, we must travel back in time to 1972. The world was a different place. The United States was still mired in Vietnam. The Watergate scandal was beginning to unfold, and the stock market was in the grip of the Nifty 50 mania, an era where investors believed that certain blue-chip stocks were so good they could be bought at any price. In Omaha, Nebraska, however, two partners, Warren Buffett and Charlie Munger, were about to make a decision that would become a legend in the world of business analysis and capital allocation. They were looking at a candy company. Not a technology firm, not a Wall Street bank, but a simple, family-owned chocolate business based in California called See's Candies. The asking price was $30 million. The company was earning about $2 million after tax. For Buffett, a man trained in the school of deep value investing by his mentor Benjamin Graham, this price felt steep. Graham taught him to buy businesses for less than their liquidation value, to buy dollars for 50 cents. See's Candies at this price was no statistical bargain. It was selling for a significant premium over its tangible assets, its factories and inventory. Buffett's initial instinct was to walk away, but his partner, Charlie Munger, saw something deeper. He understood that the true value of See's wasn't in its tangible assets, but in its intangible ones. He urged Buffett to look beyond the balance sheet and understand the business itself. So they did what a prospective business owner would do. They didn't just look at the numbers, they investigated the essence of the company. They saw a brand that was revered throughout California. They saw customers who would happily drive across town and wait in long lines, not just for chocolate, but for Time See's chocolate. They saw a product that was given as a gift for birthdays, for Valentine's Day, for Christmas. It was woven into the very fabric of family traditions. This gave the company incredible pricing power. Every year, the managers at See's could raise the price of their chocolates, and customers wouldn't flinch. They weren't just buying a confection. They were buying a feeling, a memory, a guarantee of quality. This intangible brand loyalty was a fortress, a competitive advantage that no spreadsheet could fully capture. Buffett and Munger realized they weren't being asked to pay for factories and sugar. They were being asked to pay for a piece of their customers' minds. They negotiated the price down to $25 million and bought the entire company. It was a pivotal moment in Buffett's career. It was the moment he transitioned from a pure cigar butt value investor, looking for discarded companies with one last puff of value, to a true business analyst, willing to pay a fair price for a wonderful company. See's Candies became a cash geyser for their holding company, Berkshire Hathaway. That initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire, cash that required little to no additional capital investment. That cash was then redeployed to buy other great businesses, funding the growth of the entire empire. They didn't buy See's stock, they bought See's. They became owners, and they thought like owners. They cared about the brand, the management, the customer experience, and the long-term cash-generating power of the business. The daily fluctuation of what the market might have valued See's at was completely irrelevant to them, because they owned the whole thing. This is the ownership mindset in its purest form. The psychological principle that makes this mindset so powerful is a direct countermeasure to the cognitive biases that plague most retail investors. The most prominent is what psychologists call the endowment effect. Studies have shown that people place a higher value on an object they own than they would be willing to pay for the same object if they did not own it. When you mentally frame a stock purchase as buying a fractional piece of a business that you toll Rav, you are triggering the endowment effect in your favor. It's no longer just a ticker symbol, a fleeting digital asset. It is your traits 2 piece of the Coca-Cola Company, your traits 2 share of Apple's global ecosystem. This sense of ownership makes you far less likely to sell it in a panic during a market downturn. You value it more deeply because it is yours. Contrast this with the gambler, who feels no ownership over the symbols on the screen. They are just chips in a game, easily discarded. Furthermore, this mindset helps combat the Dunning-Kruger effect, a bias where people with low ability at a task overestimate their ability. The stock market speculator, armed with a trading app and a few news headlines, often believes they are a financial wizard. But the moment you force yourself to think like a business owner, a deep and profound humility sets in. You are forced to confront the limits of your knowledge. Do you truly understand how this company makes money? Do you understand its competitive landscape? Do you know its management team? This humility is a prerequisite for successful long-term investing. So how do you, as an individual investor, apply this? You use a mental model I call the private buyer test. This is a practical, step-by-step blueprint for forcing the ownership mindset upon your decision-making process. Step 1. Before you even think about placing an order, forget the ticker symbol and the stock price. Write down the full name of the company on a piece of paper. Step 2. Look up the company's market capitalization. This is the total value of all its shares. Now ask yourself the defining question. If I had that exact amount of money in cash right now, would I buy this entire company, lock, stock, and barrel? This question is a powerful filter. It immediately changes the frame of reference from a small, abstract trade to a monumental business acquisition. Step 3. If your answer is yes, your work has just begun. You must now write a one-page memo to yourself as if you were presenting to an investment committee. In this memo, you must justify the purchase. You must articulate, in simple language, what the business does, who its customers are, why it has a durable advantage, and how you see it growing over the next decade. You cannot use market jargon. You must explain it as a business proposition. Step 4. If your answer is no, you must also write a memo. You must articulate exactly why you would not buy the whole company. Is the price too high? Is the industry in decline? Is the management untrustworthy? Is the competition too fierce? This process of articulating your reasoning is crucial. It prevents you from buying into hype or acting on a flimsy tip. It forces clarity of thought. By putting every potential investment through the private buyer test, you cease to be a passive speculator. You become an active, discerning capital allocator, a CEO of your own personal holding company. The antithesis to this disciplined approach is the path walked by 99% of market participants. This is the path of the ticker symbol gambler. Their experience is one of constant, low-grade anxiety. They wake up and immediately check their portfolio on their phone. Their mood for the day is set by the color they see. Green is relief, red is despair. Their research consists of scanning news headlines, catching snippets of financial news television, and reading anonymous posts on internet forums. They are drawn to stories, to narratives of disruption and explosive growth, but they have no real understanding of the underlying business fundamentals. They fall for what is known as narrative economics. Consider the dot-com bubble of the late 1990s. Investors weren't buying businesses, they were buying concepts. They bought Pets.com not because they had analyzed its flawed business model of shipping heavy bags of dog food at a loss, but because they bought into the idea of the internet revolutionizing everything. They weren't owners, they were ticket holders in a global lottery. The ticker symbol gambler mistakes activity for achievement. They are constantly trading, buying a stock that's going up, selling it as soon as it dips, then chasing the next hot thing. They are perpetually whipsawed by market volatility, buying high on greed and selling low on fear. They are playing the market's game, a game designed to enrich brokers through commissions and prey on human emotion. The CEO investor, the business owner, is playing a different game entirely, a game of value, patience, and long-term compounding. The direct financial connection of this mindset shift is profound and can be seen clearly on the financial statements and in your portfolio's performance. The gambler is obsessed with one number, the stock price. It is the only metric they track. The business owner, however, looks at a completely different set of numbers. They are concerned with owner earnings, a concept Buffett popularized. This is the true cash flow of the business, the net income plus depreciation and amortization minus the capital expenditures needed to maintain the business's competitive position. This number tells you how much cash the business is generating for you, the owner. The business owner is obsessed with return on invested capital, ROIC, which measures how efficiently the company's management is using the capital at its disposal to generate profits. A high and stable ROIC is a hallmark of a great business. A speculator doesn't know what ROIC is, nor do they care. By focusing on the cash-generating ability of the business rather than the market's daily opinion of it, you align yourself with the true source of value creation. Over the long term, a stock's price will inevitably follow the trajectory of its underlying business value and earning power. By adopting the ownership mindset, you are tying your financial future to the predictable, measurable progress of great businesses, rather than the chaotic, unpredictable whims of the market. This is the first and most critical step in building a portfolio for real, sustainable growth and achieving the kind of financial freedom that insulates you from the noise and panic of the crowd. Once you have adopted the ownership mindset, the next logical question a CEO would ask is, what kind of business should I buy? You wouldn't buy a business that could be wiped out by a new competitor next year. You would look for a business with a protective barrier, a sustainable edge that keeps competitors at bay and profits flowing. In the language of Buffett, you would look for a business with a wide and durable moat. This is our second pillar, the search for a durable competitive advantage. The moat is the single most important factor in determining the long-term success of a business. It is what allows a company to fend off rivals and earn high returns on capital for many years. To truly grasp the power of a moat, we must go to 1988, just after one of the most terrifying market crashes in modern history. On October 19, 1987, known as Black Monday, the Dow Jones Industrial Average plummeted nearly 23% in a single day. Fear was palpable. Investors were convinced it was the beginning of another Great Depression. They were dumping stocks indiscriminately, selling everything. regardless of quality. In this environment of pure panic, Warren Buffett was calmly doing his homework. He saw the chaos not as a threat, but as an opportunity. One company that caught his eye was the Coca-Cola Company. On the surface, it was just a soda business. But Buffett, applying his business owner lens, saw something far more powerful. He began his analysis. He read decades of the company's annual reports. He studied its history, its brand, its global expansion. He famously noted that he had been researching the product his entire life, consuming it daily. He saw that Coca-Cola wasn't just a beverage, it was an institution. It was the most recognized brand on planet Earth. The name itself, written in its iconic Spencerian script, was a piece of mental real estate in the minds of billions of people. This brand recognition was a formidable moat. Could a new startup, let's call it Bob's Cola, come along and compete? They could create a beverage that tasted identical, even better. They could price it lower. But they could never buy the century of memories, the association with happiness, family, and Americana that was baked into the Coca-Cola brand. But the moat was deeper than just the brand. Buffett saw a worldwide distribution system that was an absolute masterpiece of logistics. Coca-Cola had built a network of bottlers and distributors that could get its product within arm's reach of desire in virtually every country on the planet. For a competitor to replicate this network would require tens of billions of dollars and decades of work. It was a practically unassailable advantage. So in the aftermath of the 1987 crash, as others were panic selling, Buffett began buying. He invested over $1 billion, acquiring a significant stake in Coca-Cola. He wasn't buying a stock he hoped would go up. He was buying a piece of a global empire that he believed was fundamentally undervalued by a terrified market. He saw the castle and its impenetrable moat, and he knew that while the market was panicking about the storm outside, the castle itself was safe and would continue to generate immense wealth for its owners. That investment in Coca-Cola became one of the most successful of all time, a testament to the power of identifying and investing in a business with a truly durable competitive advantage. The underlying psychological principles that make moats so powerful are scarcity and social proof. A business with a wide and durable moat is, by its very nature, a scarce asset. There are tens of thousands of publicly traded companies, but only a handful possess a truly dominant, long-lasting competitive advantage. This economic scarcity makes them inherently more valuable. Our brains are wired to desire things that are rare and difficult to obtain. A great business is the financial equivalent of a rare diamond. Furthermore, many moats are built on the foundation of social proof. This is the tendency for people to copy the actions of others in an attempt to undertake behavior in a given situation. When you see billions of people around the world choosing Coke every day, it creates a powerful feedback loop. The choice feels safe, correct, and normal. This social proof reinforces the brand's dominance and makes it even harder for a competitor to break through. Buffett's genius lies in his ability to identify the structural reasons for this enduring social proof. While most investors get distracted by what he calls the institutional imperative, the tendency of organizations to mindlessly imitate what their peers are doing, leading them to chase fads and invest in moatless businesses. They fall for shiny object syndrome, chasing the new, exciting technology, while Buffett quietly buys the boring but unbreachable fortress. To make this concept practical, you can use a mental model called the Moat Identification Framework. This is a checklist to help you analyze a company's competitive position. There are 4 primary sources of economic moats. 1. Brand power. A strong brand allows a company to charge a premium for its products. The key question to ask is, if this company doubled the price of its flagship product tomorrow, would it still retain the vast majority of its customers? Think of Apple's iPhone or a Hershey's chocolate bar. The answer is likely yes. That is brand power. 2. Switching costs. This occurs when it is expensive, time-consuming, or a general pain for a customer to switch from one product to another. Think about the bank where you have your checking account. Moving all your direct deposits and automatic payments would be a massive hassle, so you stick with them even if another bank offers a slightly better interest rate. That's a switching cost moat. Microsoft Windows has an enormous switching cost moat for large enterprises. 3. Network effects. A business has a network effect when its product or service becomes more valuable as more people use it. Think of a credit card network like Visa or MasterCard. The more merchants that accept Visa, the more useful it is for cardholders. The more cardholders who have Visa, the more essential it is for merchants to accept it. This creates a powerful, self-reinforcing cycle. Social media platforms also benefit from this. 4. Cost advantages. This is when a company can produce and deliver its products or services at a consistently lower cost than its rivals. This can come from immense scale, like Walmart's ability to demand lower prices from suppliers, or from a unique process, like Geico's direct-to-consumer insurance model, which bypasses costly agents. When you are analyzing a potential investment, run it through this framework. Does it have a powerful brand, high switching costs, a strong network effect, a significant cost advantage? A truly great business will have a deep, wide moat sourced from at least one of these categories. Many of the best have more than one. The antithesis of this careful, moat-focused analysis is the growth at any price trap, a siren song that has led countless investors to financial ruin. This investor becomes infatuated with revenue growth above all else. They see a company whose sales are increasing at 50 or 100% per year, and they dive in head first, without asking the critical question, is this growth profitable? And more importantly, is it defensible? They mistake a temporary land grab in a new industry for a permanent competitive advantage. Consider the thousands of meal kit delivery companies that sprang up a few years ago. They showed incredible revenue growth, but what was their moat? They had no brand loyalty. Customers would switch to whichever service offered the best introductory discount. They had no switching costs. Canceling one subscription and starting another took 5 minutes. They had no network effects. And they had no cost advantages. In fact, they had horrendous unit economics, spending huge amounts on marketing to acquire each new customer. When larger players with deeper pockets entered the market, most of these high-growth darlings were crushed. The investor who chased the growth story without analyzing the moat was left holding a worthless stock. They bought the sizzle and forgot to check if there was any stake. The direct financial connection between a durable moat and your portfolio's growth is undeniable. A moat manifests itself directly on a company's financial statements in the form of consistently high profit margins and a superior return on tangible assets. A company without a moat is in a constant battle. Competitors can easily enter its market, forcing prices down and compressing margins. The company has to spend heavily on marketing just to maintain its market share. It's a brutal, low-margin existence. A company with a wide moat, however, is protected from this intense competition. It can price its products based on the value they provide, not based on the competitor's price. This leads to fat profit margins. Because it doesn't have to fight a constant price war, its revenues are more stable and predictable. This financial stability allows the company to generate enormous amounts of free cash flow, which can then be returned to shareholders through dividends and share buybacks, the twin engines of long-term wealth creation. A moat is a license for a business to print money for its owners year after year. When you are doing your fundamental analysis as a business owner, searching for these moats isn't just an academic exercise. It is the core of a strategy for beating the market and building a portfolio that can withstand any economic storm. So, you've adopted the mindset of an owner, and you've learned to identify businesses with fortress-like competitive moats. The next question a discerning CEO would ask is, who is running this company? A wonderful business with a great moat can be systematically destroyed by incompetent or self-serving management. Conversely, an average business can be transformed into a superstar by a brilliant and shareholder-friendly leadership team. This brings us to our third pillar, the primacy of management and capital allocation. For Buffett, Betting on the right people is just as important as betting on the right business. To understand this principle in action, we must look at his relationship with two of the greatest corporate managers of all time, Tom Murphy and Dan Burke, the executives who ran Capital Cities Communications. In the 1980s, Capital Cities was a media company, but it was run with a discipline and efficiency that was unheard of in the industry. Murphy and Burke were legendary for their operational excellence and, more importantly, for their genius in capital allocation. They were notoriously frugal, operating out of modest offices and shunning the lavish corporate perks common among their peers. But their real talent was in how they deployed the company's cash. They made a string of brilliant, value-accretive acquisitions, buying television stations and newspapers at fair prices, and then dramatically improving their operations. Buffett watched them for years, admiring their work from afar. He saw in them a rare combination of talent and integrity. They didn't just run the business, they thought like owners. Their primary goal was to increase the intrinsic value per share for the company's shareholders. In 1985, an incredible opportunity arose. ABC, one of the three major television networks in the United States, was available for purchase. The problem was that ABC was many times larger than Capital Cities. Murphy needed financing for the deal, a massive $3.5 billion acquisition. So he called the one person he knew would understand the business logic of the deal, Warren Buffett. Buffett didn't hesitate. He agreed to provide over $500 million in financing, a huge sum for Berkshire Hathaway at the time. Why? Was he an expert in the television network business? Not particularly. His investment was not a bet on ABC, it was a bet on Tom Murphy and Dan Burke. He famously said, "I'll back anyone Tom Murphy wants to back." He knew that putting Berkshire's capital in their hands was one of the smartest investments he could possibly make. The acquisition was a stunning success. Murphy and Burke applied their operational discipline to the much larger ABC, slashing unnecessary costs and dramatically improving profitability. The value of Buffett's investment soared. This story is the ultimate illustration of the principle. When you find brilliant, honest, and shareholder-oriented management, you should bet on them heavily. They are the stewards of your capital. The core psychological challenge here is overcoming what is known as agency theory while exercising sound judgment. In any public company, there is an inherent potential conflict of interest between the shareholders, the principals or owners, and the management team, the agents, who are hired to run the company. A bad management team will act in its own self-interest, not the owners. They might pay themselves exorbitant salaries, use corporate funds for lavish perks, or pursue empire-building acquisitions that boost their own prestige but destroy shareholder value. Buffett's entire approach to evaluating management is designed to find agents who think and act like principals. This requires a deep assessment of trust and character, forcing an investor to look past the superficial charisma of a CEO and analyze their actual track record. It requires overcoming the halo effect, a cognitive bias where our impression of a person in one area influences our opinion of them in another. A CEO might be a fantastic public speaker and visionary, but a terrible capital allocator. The disciplined investor must separate the two. How can you apply this principle? You can use a mental model called the management scorecard. It has three main components. First, analyze the track record. This is the most important test. Go back and read the CEO's annual letters to shareholders for the past 10 years. In each letter, the CEO will lay out their strategy and their goals for the coming year. Your job is to play detective. Did they do what they said they would do? Are their pronouncements consistent over time, or do they change their story every year to fit the latest market fad? A great CEO's letters will read like a coherent, unfolding story of long-term value creation. A poor CEO's letters will be full of jargon, excuses, and shifting goalposts. Second, conduct the capital allocation test. This is the ultimate measure of a CEO's skill. How does the company use its free cash flow? There are only 5 things they can do with it. 1. Reinvest it back into the core business. This is a great choice if the returns on that reinvestment are high. 2. Make intelligent acquisitions. 3. Buy back the company's own shares. This is a brilliant move when the stock is trading below its intrinsic value, as it increases your ownership stake in the business. 4. Pay a dividend. Or 5. Let the cash pile up on the balance sheet. Your job is to evaluate their decisions. Have their acquisitions created value? Do they buy back shares aggressively when the stock is cheap, or do they foolishly buy it back when it's expensive? Their capital allocation decisions are the clearest window into their financial acumen. Third, check for skin in the game. Look at the company's proxy statement. Does the CEO own a substantial amount of the company's stock? Crucially, did they buy that stock with their own money, or was it all granted to them as part of their compensation package? You want to see a CEO who has a significant portion of their own personal net worth tied up in the success of the business. This aligns their interests directly with yours. The opposite approach, the path of the 99%, is to fall for the storyteller's CEO fallacy. Most investors are easily seduced by charismatic leaders who are masters of public relations. These CEOs appear frequently on financial television, they are quoted in magazines, and they spin a compelling narrative about how their company is going to change the world. They are fantastic at raising capital but often terrible at allocating it. Think of Adam Neumann at WeWork, a master storyteller who convinced investors to pour billions into a fundamentally flawed business, all while enriching himself. The average investor gets swept up in the vision and the charisma, and they never bother to perform the rigorous analysis of the CEO's actual track record or capital allocation decisions. They are investing in a personality, not a business manager. This is a recipe for disaster. A great business analysis can be completely undone by backing a CEO who is a promoter instead of a performer, a storyteller instead of a steward. The direct financial connection of this principle is arguably the most powerful of all. Superior capital allocation is the single greatest long-term driver of shareholder returns. Let's quantify this. Imagine two identical companies, Company A and Company B. Both generate $10 million in free cash flow each year. The CEO of Company A, a poor capital allocator, uses that cash to make a series of mediocre acquisitions in unrelated industries. These acquisitions don't generate good returns and distract management from the core business. The CEO of Company B, a brilliant capital allocator, sees that his company's stock is undervalued. He uses the $10 million in cash to aggressively buy back shares. Over a decade, the CEO of Company A has built a bloated, inefficient conglomerate. The CEO of Company B has significantly reduced the number of shares outstanding, meaning that each remaining share is now entitled to a much larger piece of the company's earnings. The earnings per share EPS of Company B will have grown dramatically, even if the total earnings of the business haven't. This will almost certainly lead to a much higher stock price. The choice of CEO and their skill in capital allocation directly translates into massive differences in portfolio growth and capital gains for their shareholders. When you invest, you are not just buying a business, you are hiring its CEO to work for you. Choose wisely. You have now internalized the owner's mindset, learned to identify a durable moat, and developed a framework for assessing management. You have found a wonderful business run by honest and able people. The final question a CEO must ask before an acquisition is perhaps the most important. What price should I pay? Buying a great company at a terrible price can lead to a terrible investment outcome. You must protect yourself from overpaying, from getting carried away by enthusiasm and market euphoria. This brings us to our fourth pillar, the cornerstone of value investing, the margin of safety principle. This concept, first articulated by Benjamin Graham, is the secret to both preserving capital and generating exceptional returns. To witness its power, we must go to 1963 and explore one of Buffett's greatest investment triumphs, the American Express salad oil scandal. American Express in the early 1960s was a blue-chip company, primarily known for its traveler's checks and charge cards. However, they had a smaller division involved in warehousing. This division issued receipts to companies for the inventory they stored in Amex's warehouses. These receipts were then used as collateral for bank loans. One of their biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino De Angelis. In 1963, it was discovered that De Angelis was a fraud. His company's giant vats, supposedly full of valuable salad oil, were mostly full of seawater, with only a thin layer of oil floating on top. The company went bankrupt, and the banks that had loaned money against the fraudulent receipts were facing massive losses. They turned to American Express, whose receipts they had trusted, demanding to be made whole. Wall Street panicked. The fear was that the scandal would bankrupt American Express, that the liability would be so enormous it would wipe out the company. The stock price was obliterated, falling by nearly 50%. It was a bloodbath. This is where Warren Buffett, the business owner, went to work. He didn't listen to the screaming headlines or the panicked analysts on Wall Street. He decided to do his own primary research. He started by asking a simple question: has this scandal affected the underlying businesses of American Express? To find the answer, he didn't look at a stock chart. He went to restaurants in Omaha. He talked to the cashiers and owners. Were people still using their American Express cards? Yes, they were. He went to local banks. Were they still selling American Express travelers' checks? Yes, they were. He even went to see his competitors in the travel agency business and asked them if they were seeing customers switch to other travelers' checks. They weren't. From his on-the-ground research, Buffett concluded that the scandal, while a serious financial hit, had not damaged the two golden geese of the company, the card business and the traveler's check business. The moat was intact. The customers still trusted the brand. He then did a financial analysis and estimated that the maximum possible loss from the scandal was far less than the market was implying. He realized that the market was pricing American Express for bankruptcy when its core businesses were still immensely profitable and untouched. He had found a massive gap between the price of the company and its true intrinsic value. This gap was his margin of safety. He invested 40% of his partnership's capital into American Express stock. Over the next few years, as the company settled the legal claims and its powerful earnings engine continued to churn, the stock price soared. Buffett made a fortune for his investors, not by predicting the future, but by buying a great business at a ridiculously cheap price during a moment of maximum fear. The margin of safety is a direct psychological weapon against two of the most powerful and destructive human emotions in investing: fear and greed, which manifest as loss aversion and herd mentality. Loss aversion is the well-documented psychological finding that the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. This is why market panics are so brutal. When people see their portfolio values dropping, the intense pain of loss aversion kicks in, compelling them to sell at the worst possible time just to make the pain stop. The margin of safety is a rational buffer against this. If you know you bought a business for 50 cents on the dollar, a 20% drop in the stock price doesn't trigger the same fear. You know the market is being irrational and that your investment is still cheap. Herd mentality is the tendency to follow the actions of a larger group, whether those actions are rational or not. During bubbles, the herd buys, driven by greed and the fear of missing out. During crashes, the herd sells, driven by fear and panic. The margin of safety is an act of intellectual independence. It forces you to do your own work, to arrive at your own estimate of value, and to only act when the price offers a significant discount to that value, regardless of what the herd is doing. It is the ultimate tool for being greedy when others are fearful, and fearful when others are greedy. To apply this principle, you need a practical mental model for estimating value and demanding a discount. We'll call this the intrinsic value calculation blueprint. Step 1. Determine a conservative estimate of the business's intrinsic value. The most common method for this is a discounted cash flow (DCF) analysis. This sounds intimidating, but the concept is simple. You estimate all the cash the business is likely to generate for its owners over its lifetime, and then you discount that future cash back to what it's worth in today's dollars. The goal is not to be perfectly precise. The future is unknowable. The goal is to be approximately right. You want to come up with a reasonable, conservative range of what a private buyer would be willing to pay for the entire business. Step 2. Demand a discount. The margin of safety is the difference between your calculated intrinsic value and the current market price. A true value investor will never buy a stock that is trading at or near their estimate of its intrinsic value. They demand a significant discount to protect themselves against errors in their judgment or unforeseen negative events. A common rule of thumb is to look for a price that is at least a third, and ideally a half, below your conservative estimate of intrinsic value. You are trying to buy $1 of value for 50 or 60 cents. Step 3. Use the 3 scenarios technique. To build an even greater buffer, run your valuation under 3 different sets of assumptions: an optimistic case, a realistic or base case, and a pessimistic case. A truly compelling investment opportunity is one where the stock still looks cheap, even under your pessimistic scenario. This creates a margin of safety on top of your margin of safety, providing the ultimate protection for your principal. The antithesis of this disciplined, price-conscious approach is the trap of paying for perfection. This is the investor who correctly identifies a wonderful business with a wide moat and great management, but then becomes so enamored with the quality of the company that they completely ignore the price they are paying. They convince themselves that quality is worth any price. This was the thinking behind the Nifty 50 stocks in the early 1970s. Companies like Coca-Cola, IBM, and McDonald's were considered so dominant and so certain to grow forever that investors bid their stock prices up to astronomical valuations, sometimes over 50 or 60 times their earnings. The problem is that these high prices assumed decades of flawless execution and uninterrupted growth. When the inevitable recession hit in the mid-70s and these companies' growth slowed even slightly, their stock prices collapsed, some falling by over 70%. The businesses were still great, but the investors who had paid for perfection suffered devastating losses. There is no business so wonderful that you can't overpay for it. The margin of safety is the discipline that protects you from your own enthusiasm and ensures that you get a fair deal, even when buying the best companies in the world. The direct financial connection between the margin of safety and your long-term wealth is twofold and incredibly powerful. First, and most obviously, it is your primary defense against permanent capital loss. If you buy a business at a significant discount to its intrinsic value, and you happen to be wrong about its future prospects, you are far less likely to lose money. The discount acts as a cushion. Your downside risk is dramatically limited. This preservation of capital is the foundation of all successful investing. But the second effect is where the real magic happens. The margin of safety is also the source of outsized returns. When you buy $1 of value for 50 cents, you have 2 ways to win. You win as the underlying value of the business grows over time, and you win again as the market price eventually converges with the business's intrinsic value. This double dip is what generates the exceptional capital gains that define the records of the world's greatest investors. It is the engine of value investing. By systematically demanding a margin of safety in every investment you make, you are not only protecting yourself from loss, but you are also building a portfolio with a structurally higher potential for beating the market and achieving exponential portfolio growth. We have arrived at the final and perhaps most challenging pillar of the CEO mindset. You've adopted the perspective of an owner. You've found a wonderful business with a durable moat. You've vetted its management and confirmed they are talented and honest. You've patiently waited until the market offered you a price that provided a significant margin of safety. You have made your purchase. Now what? The answer, for the true business owner, is the most difficult action of all. You do nothing. You let the business work its magic for you over many years. This is our 5th pillar, the patience of a long-term owner. This principle requires a temperament that runs contrary to our modern culture of instant gratification and constant action. It is the understanding that the true fortunes are made not in the buying or the selling, but in the waiting. To understand the origin of this lesson for Buffett, we must go all the way back to the very beginning of his journey, to 1942, when an 11-year-old Warren Buffett made his first investment. World War II was raging. A young Buffett, already a voracious reader of financial books, decided to take the plunge into the stock market. He had been saving money from his paper route and various small ventures. He convinced his sister, Doris, to join him, and together they bought 3 shares of a company called City Service Preferred for $38.25 per share. Almost immediately after he bought it, the stock began to fall. It dropped all the way to $27. The young Buffett was consumed with anxiety. He felt the sting of the loss acutely, especially because he had brought his sister into the investment. He checked the stock price constantly. It was a painful lesson in market volatility. He held on, his stomach in knots, as the stock slowly recovered. When it finally ticked back up to $40, he sold immediately, locking in a tiny profit of $5 for their 3 shares. He felt a wave of relief. He had escaped. But then, he watched in agony as City Service Preferred stock, freed from his impatient grasp, proceeded to rocket up to over $200 per share. That small trade, made by an 11-year-old boy in Omaha, seared 3 lessons into his mind that would go on to shape his entire investment philosophy and build a $100 billion fortune. Lesson 1. Don't fixate on the short-term, meaningless gyrations of the stock price. Lesson 2. Don't be in a rush to sell a good business just to lock in a small, quick profit. And lesson 3, the most important of all, true wealth is built by owning great businesses and having the patience to let them compound over a very, very long time. That early failure was the most valuable investment he ever made. It taught him that the stock market is a device for transferring money from the active to the patient. It was the birth of his lifelong commitment to long-term ownership. The psychological forces working against this pillar are immense and deeply ingrained in our evolutionary wiring. The first is hyperbolic discounting. This is our brain's powerful tendency to prefer smaller, immediate rewards over larger, delayed rewards. A guaranteed $5 profit today feels much more compelling to our primitive brain than the potential for a $500 profit 5 years from now. This is why it's so tempting to sell a winning stock after it's up 20%. The immediate gratification of locking in that gain is hard to resist, even if the rational, long-term decision is to hold on. The second is action bias. This is our innate compulsion to do something in situations of uncertainty, even when inaction is the more logical course. When the market is volatile, the action bias screams at us to sell, to buy, to rebalance, to do anything, to feel like we are in control. The act of patiently doing nothing feels passive and wrong. Buffett's entire philosophy of long-term holding is a conscious and deliberate system for overriding these powerful, wealth-destroying biases. He has engineered his temperament and his environment to favor inaction over action, patience over impatience. How do you build this superhuman patience into your own investment process? You use 2 powerful mental models that Buffett himself advocates for. The first is the 10-year test. Before you buy a single share of any company, you must ask yourself this question: would I be perfectly happy to own this business for the next 10 years, even if the stock market were to shut down tomorrow and I couldn't see a price quote? This simple question forces a profound shift in perspective. It makes the daily stock price completely irrelevant. The only thing that matters is your assessment of the business's ability to grow its earning power over the next decade. If you can't confidently answer yes to this question, you should not buy the stock. It is a filter that eliminates short-term speculations and focuses you exclusively on durable, long-term investments. The second mental model is the 20-slot punch card. Buffett asks you to imagine that at birth, you were given a punch card with only 20 slots on it. Each time you make an investment decision in your entire life, you have to punch one of those slots. Once all 20 are punched, you can't make any more investments. This mental framework of extreme scarcity forces you to be incredibly selective. You wouldn't waste a punch on a half-baked idea or a speculative bet. You would do enormous amounts of research, you would wait patiently for the perfect pitch, and you would only invest in your absolute highest conviction ideas. And once you've punched that slot, you would be far more inclined to hold on to that investment for a very long time, because each decision is immensely valuable. The antithesis to this patient, long-term approach is the frenetic trader. This person's portfolio is a revolving door. They are constantly scanning for the next hot tip, the next momentum play. Their screen is a dizzying array of charts, technical indicators, and real-time news feeds. They are constantly buying and selling, mistaking this flurry of activity for progress. But what are the actual results of this behavior? First, they are destroyed by costs. Every trade generates a commission. Their constant churning enriches their broker at their own expense. Second, they are punished by taxes. By selling stocks they've held for less than a year, they are subject to short-term capital gains taxes, which are taxed at a much higher rate than long-term capital gains. This is a massive, self-inflicted drag on their returns. But most importantly, they never, ever allow the eighth wonder of the world to work for them, the magic of compound interest. They are constantly pulling up their financial saplings to see if they are growing, and in doing so they ensure they will never have a mighty oak tree. The direct financial connection of long-term patient ownership is the most powerful force in all of finance. It is the power of compounding. Let me illustrate this with a simple example. Let's say you invest $10,000 in a great business that manages to grow at a rate of 15% per year. After 10 years, your investment will be worth just over $40,000, a nice return. But this is where the magic begins. In the next 10 years, your investment doesn't just grow by another $30,000. It grows to over $160,000. And in the 10 years after that, it balloons to over $660,000. The vast majority of the gains, the truly life-changing wealth, is created in the later years. The frenetic trader who sells after a year or two never gets to experience that exponential explosion of growth. Furthermore, as we mentioned, a long-term holding strategy is incredibly tax-efficient. By holding an investment for more than a year, any eventual gains are taxed at the much lower long-term capital gains rate. This difference in tax treatment can add tens or even hundreds of thousands of dollars to your net worth over an investing lifetime. Patience isn't just a virtue in investing, it is a direct and quantifiable financial strategy. It is the final essential element of the CEO mindset, the discipline that allows you to transform good business analysis into generational wealth and achieve a state of true and lasting financial freedom. You have just been given a new framework for thinking about the world of money and markets. You've moved beyond the noise and the flashing lights. You've installed a new operating system for your financial mind, what we've called the CEO mindset. You now understand that a stock is not a lottery ticket. It is a piece of a business. You've learned to search for the protective moats that guard a company's profitability, to scrutinize the managers who act as the stewards of your capital, to demand a margin of safety in every price you pay, and to cultivate the patience required to let the miracle of compounding work for you. This is a complete mental arsenal, a powerful tool you have just acquired. But this mindset, this fundamental principle of viewing a stock as a business, is the foundational gear in a much larger and more intricate machine. It tells you how to think. But what about the specific, tactical models for finding the next great business before the rest of the market does? How do you build a quantitative screen to filter through thousands of companies to find the ones with impenetrable moats? How do you calculate a precise margin of safety when the future is, by its very nature, uncertain? How do you structure a portfolio of these great businesses for optimal growth and minimal risk? The journey of a true capital allocator is one of continuous learning. The video that YouTube has queued up for you next is designed to be the next piece of that map. It is the link that connects the foundational philosophy you've just mastered to the tactical execution needed to build a truly market-beating portfolio. It is the bridge from theory to practice, the next step on the path, from amateur speculator to professional investor. Most people will stop here, content with this new knowledge. They will feel inspired for a day or two and then fall back into old habits. But for those of you who are serious, for those who see this not as entertainment but as the very blueprint for your financial future, the journey must continue. The decision to click is not just a decision to watch another video. It is a declaration. It is a commitment to continue your ascent, to complete your mental arsenal, and to take command of your own financial destiny. The choice is yours. Continue the journey.